Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome everyone to this explainer. You know, when we think about the 2026 FIFA World Cup, our minds immediately go straight to the roar of the crowds, right? The stunning goals, the intense rivalries, and just the ultimate athletic competition on the world stage. But behind the scenes, right alongside that athletic playbook, there's actually a hidden, highly complex financial playbook that every single foreign participant absolutely must master. Today we're zeroing in on the intricate web of U.S. tax compliance. If you're a foreign individual or entity participating in this massive event, well, the IRS is definitely paying attention. So let's explore exactly what that means.
Okay, let's dive right into this and walk through our game plan. We're going to start with Welcome to the World Cup to get a sense of the scale. Then, we'll tackle the formidable 30% rule. From there, we'll look at claiming tax treaty benefits, outline some special rules for artists, athletes, and CWAs, and finally, cross the finish line with final filings and state taxes. All right, let's kick things off with Section 1, Welcome to the World Cup. To really wrap our heads around the tax implications, we first need to comprehend just how incredibly massive this upcoming tournament is going to be. Just look at this number, 104. That's the total number of matches that'll be played between June 11th and July 19th, 2026. And honestly, this tournament is making history. It features an expanded roster of 48 national teams. Plus, for the very first time, it's being jointly hosted by 3 nations, the United States, Canada, and Mexico. The logistics for the whole shebang are literally staggering. But here's the number that matters most for our focus today, 78. Out of those 104 total matches, 78 of them, including the highly anticipated final, are going to be hosted right here in the United States, spread out across 11 different host cities. Because the vast majority of the tournament happens on American soil, this creates an absolutely massive window of U.S. tax exposure for all the foreign participants involved. Which brings us to a really important question. What is the hidden opponent off the pitch? Well, for non-resident individuals and foreign entities, that opponent is U.S. tax obligations. The general rule of thumb here is that these foreign participants are subject to tax on their U.S. source income, basically any earnings directly connected with activities performed inside the United States. You can't just come, play, earn, and leave. It doesn't work like that. And that brings us right into Section 2, the 30% rule. This is the baseline hurdle of U.S. federal taxation, and honestly, it's the one that catches so many foreign participants completely off guard. Now, what's really interesting about this is the immediate financial impact. If you're earning non-employee compensation, say, earnings from independent personal services, as a contractor or a performer, you are generally subject to a flat, automatic 30% federal withholding tax on the gross amount of your U.S. source payments. Let that sink in for a second. You get paid, actually scratch that, before you even see a dime, 30% of the gross payment is carved right out and sent straight to the federal government. However, your exact employment status dictates the rules of the game here. If a foreign person is officially classified as an employee, they fall under separate payroll withholding rules, which are based on graduated rates under standard U.S. wage withholding. But if you're an independent contractor or you're performing independent services, boom, you face that flat 30% federal withholding we just talked about. Getting this classification right is absolutely vital. So who's actually responsible for taking that 30% out? Well, the withholding agents. These agents, which usually means the promoter, the league, the team, or the event organizer, they actually hold the bag here. They must withhold this tax and physically remit it to the IRS. And their job doesn't end there. They're also strictly required to report these payments and the tax withheld using Form 1042 and Form 1042-S. So the burden of compliance starts heavily on the organizers. So how do you defend against losing a flat 30% of your gross income right out of the gate? Let's transition to our defensive strategy in Section 3, claiming tax treaty benefits. The good news here is participants aren't always stuck with that maximum 30% hit. Foreign individuals and entities might actually be able to claim a reduced withholding rate, or in some lucky cases, a total exemption. But, and this is a big but, this is only possible if there is an applicable tax treaty between the United States and their specific home country. It's a really powerful tool, but it requires some incredibly precise paperwork. To claim these treaty benefits, it's kind of like a matching game. You must match your persona to the exact required paperwork. If you're an individual performing personal services, you need to hand your withholding agent a Form 8233. If you're an individual with other types of income, you'll generally use Form W-8-BEN. And if you're a foreign entity, you'll provide Form W-8-BEN-E. And definitely notice those ID requirements too. individuals generally must have a Social Security number, an SSN, or an Individual Taxpayer Identification Number, an ITIN. Entities need an Employer Identification Number, or EIN. Whatever you do, you cannot skip these identification steps. And there's a very specific kind of tricky nuance here regarding visas that trips people up all the time. If you're an individual present in the US under a work visa, like the O1 or P1 visas that are super common for athletes and performers, you generally aren't eligible to just go and apply for an ITIN. Nope, you must apply for a Social Security number first. If the Social Security Administration determines you aren't eligible and denies you, you have to get a formal denial letter from them. Only then can you take that denial letter, attach it to a Form W-7, and apply for your ITIN. It's a very strict sequence of operations.
So the crucial point is that claiming treaty benefits requires following a really rigorous checklist. You must genuinely be a resident of the treaty country. The specific income you earn has to qualify under that exact treaty's provisions. You absolutely must have that valid SSN, ITIN, or EIN we just discussed, and you have to meet any other miscellaneous requirements buried deep in the treaty text. If you can check all these boxes, you protect your earnings.
All right, moving right along to Section 4, Artists, Athletes, and CWAs. The IRS actually has a special teams program just for foreign performers. Let's get into it. That program is called the Central Withholding Agreement, or CWA. Basically, this allows qualifying individual non-resident alien artists and athletes, specifically those performing independent personal services for a specific tour or athletic series, to negotiate an advance agreement with the IRS. So instead of that blind, flat 30% withholding we talked about, you agree in advance on the exact amount of tax to be withheld based on your projected budget and graduated rates. It's really a game changer. But keep in mind, artists and athletes performing dependent personal services, they aren't eligible for this. It's strictly for independent performers.
Now, if you want a CWA, the timeline you're up against is strictly enforced. And this brilliantly illustrates exactly how tight that window is. To request this, you have to submit a completely filled out Form 13930. But look at Step 1. This application must be submitted at least 45 days before the very first event date listed on the application. That 45-day window gives the IRS the time they need to actually process it before day 0 arrives.
You really cannot afford to procrastinate here. If the IRS receives that application even a single day less than 45 days before the first event, or if it's just not filled out properly, it will be automatically rejected and sent right back to you. Missing this deadline means you completely lose the CWA advantage, and boom, you're right back to that immediate heavy 30% withholding hit on your paychecks.
Well, that brings us to our final section, the final buzzer of our playbook. Section 5, Final Filings and State Taxes. Because, believe it or not, just because the tournament ends and the withholding agents did their jobs doesn't mean your relationship with the IRS is over.
Withholding is really just the mechanism to collect tax upfront. It is not your final tax bill. The foreign individuals and entities who actually perform the services have their own mandatory filing requirements. Foreign individuals generally must file a U.S. non-resident alien income tax return, which is known as Form 1040-NR. And on the corporate side, foreign corporations engaged in a U.S. trade or business have to file a U.S. income tax return of a foreign corporation, or Form 1120-F.
Now you might be wondering, why on earth would I go through the hassle of filing a final return if they already withheld my taxes? Well, the reasons are absolutely crucial and highly beneficial to you. First, you have to report your effectively connected income. But more importantly, you use this return to reconcile your actual tax liability with the amounts they already withheld. This is where you figure out your true taxable income, claim any allowable deductions, and grab any treaty benefits that maybe weren't fully realized during the initial withholding process. It's basically how you settle the final score with the IRS and potentially secure a refund if you were over-withheld.
But wait, let's see how this builds, because there's one more layer to our complete picture: state taxes. Think of this as the overtime round. Everything we've discussed so far, purely federal. In addition to all those federal rules, each individual U.S. state where the events occur might impose its own entirely separate state income or withholding tax on the earnings from activities conducted within its borders. Because the rules vary wildly from state to state, you've got an entirely new set of regulations to navigate depending on exactly which U.S. host cities you're performing in.
Which leaves us with this absolutely vital, provocative question. Have you built your tax strategy before the first whistle blows? The 2026 World Cup represents a massive, once-in-a-lifetime opportunity, but navigating forms like the 1042, the W-8 the CWA applications, and multiple state tax codes, it's a seriously complex endeavor. The time to start organizing your IDs, reviewing your home country's treaties, and consulting with tax professionals is right now. You've got to do it long before the tournament kicks off. Thank you so much for joining me for this explainer on the U.S. Tax Playbook. Stay curious, stay organized, and we'll see you next time.